Good morning, everyone. It's 9:25 for the week of November 10th, 2025. I am your host, Don Foyani. First and foremost, Veterans Day is on Tuesday, so I wanted to take a moment to thank our servicemen and women for the sacrifice that they have made for this country. As a U.S. citizen, I am a direct beneficiary, so I am extremely grateful. Thank you again, and I hope that on Tuesday you feel the level of gratitude that is more than deserved. And this week on the 925, I'm going to spend some time talking about the return of valuation concerns, put some upcoming quarters on your radar, and then close with some of the names with the most to gain from the reopening of the U.S. government. 5 minutes to the open on Wall Street, and we'll begin with what the return of the valuation ceiling means for stocks. And the start of this conversation should take place with how the ceiling appeared in the first place. In my opinion, I think it started with Palantir. On Monday night, they reported some of the best numbers I've seen since NVIDIA's AI moment a couple of years back, but instead of rallying, the stock fell 7 to 9%. In my opinion, this was the market in real time discovering a valuation just too rich to justify. Then, there was some weirdness with the CEO and CFO of OpenAI. The implication that their behavior exaggerated some concerns about some of the dynamics that exist in the AI ecosystem, and I'll touch on all of that later on in the brief. Finally, the government shutdown became the longest in history. Now, this might be a bit of a stretch, but I think it may have reminded investors how long we've gone without BLS data, thus how long we've gone without a complete view on the U.S. economy. And we're also reminded that for longer than a month, approximately 1.4 million government workers have gone that long without a paycheck. This creates a legitimate earnings concern for certain companies. People that don't have paychecks don't spend as much money. It's really not that difficult to understand. So you step back and the S&P 500 is trading between 22 to 24 times forward, which means the narrative needs to be bulletproof and you need to be certain that those earnings are going to come through. And between these three things, I think investors just finally decided they weren't quite sure. So they needed to reassess. Now that we understand how the valuation ceiling was put into place, how it came to be, here's what it means for the market. The first is that it isn't a bubble. We're witnessing the leadership group of the theme accused to have been in a bubble get absolutely slammed. NVIDIA shed 10% this week without a single stock-specific headline. If we were in a bubble, you'd see names in that leadership group go up 10% on a no-news week, not down 10%. Second, the bull market is still alive. The money that left the AI theme has clearly been rotating, at least to some degree, into defensive areas where there is a limited consumer exposure and to areas where the valuations are a little bit more palatable, for lack of a better term. This would provide you some insulation from consumer headwinds attached to this government shutdown and overall valuation concerns. The only names with high valuations that have been spared or have held up are those whose valuation is attached to consistency as opposed to growth. I'm talking about the Apples, Costco's, Walmarts of the world. All of these names trade above 30 times forward because of the consistency of their business. I personally made 50% trading options in Intuitive Surgical, ticker symbol ISRG. They're a medical device company with a phenomenal recurring revenue system. I like to call them the razor blade and blades of the medical device industry. They have a fantastic business. And the point of all this is that there are still companies working and there are still ways to make money despite weakness in the leadership group. Investors are not giving up on stocks. If that were the case, money would be outright leaving the stock market. And the only way to make money in the stock market would be to buy puts or to go short. So now that we understand the field of play, how do we break this ceiling? Well, just like anything else, we need a catalyst. And while I suspect the end of the government shutdown will be a meaningful way to diminish this hyperfixation we have on valuations, I'm not sure if it'll be enough to completely break through this ceiling. As I alluded to earlier, the government shutdown isn't the only damp towel cooling the markets right now. Concerns surrounding valuations and the PR hiccups at OpenAI are not going to be resolved by the government reopening again. For those that aren't up to speed, let me quickly outline these concerns that I've been hinting at for the past, let's call it 4 minutes. The first of which is circular financing. All of these deals where one company in the AI ecosystem makes a financial commitment to the other, and in turn, that company makes a financial commitment to the one that made the first financial commitment. This is called circular financing. It's analogous to the 2000s bubble. And while I view this as a false comparison because the companies that are doing it today have revenues, have earnings, have customers beyond this closed ecosystem, there are clear surface level similarities. So I do understand the concern, especially from investors that invested through that bubble. The second bit is a lack of transparency. OpenAI, whether you like it or not, is undoubtedly the most important piece on the chessboard, but we don't have complete visibility of it. As a private company, the public market, the trillions of dollars of human and financial capital aren't valuing and trading and assigning a value to OpenAI on a daily basis. It's behind closed doors. Now, obviously, there are private investors that have seen it, but it just isn't the same level of scrutiny. And OpenAI, they've partnered with everyone. As a result, they've made themselves too integral to fail. Now, that isn't an issue on its own. In fact, I think it's just really smart business. However, it does become an issue when the C-suite starts acting funny and there's no way to check on how their company is doing. Specifically, there was an odd altercation between CEO Sam Altman, who got really defensive to some legitimate questions from Brad Gerstner. He's one of the most prolific tech investors of our time, Brad, I'm talking about. Then, during a Wall Street Journal business summit, the CFO, Sarah Fryer, appeared to imply that OpenAI was looking for a government backstop to data center loans. Now, I'm oversimplifying both stories in honesty, but when you see those headlines, you start to think that maybe something is wrong. And there really isn't enough time to go through each in detail. I'll leave links to each story on my website in the link dump if you're curious to go check it out for yourself. But here is my take on the matter. While it is probably nothing, you probably shouldn't ignore it. Due to the lack of transparency surrounding OpenAI's financials, this erratic behavior leads to, in my opinion, fair speculation that something might be wrong at OpenAI, and the stress is getting to the C-suite, which is causing these kind of odd PR hiccups and moments that weren't happening before. This matters because if it is the case that OpenAI is having trouble, then every analyst who has increased numbers in public companies because of the deals they have inked with OpenAI need to revisit those estimates and bring them a tick lower. Now, this doesn't mean that anything is wrong in the long term for the AI theme. There's a lot of players in the space, and OpenAI, Perplexity, Anthropic. If one were to fail, while it might be devastating temporarily, there is someone that will step into its place. There's no shortage of suppliers in the AI theme. But it creates a scenario where the earnings estimates have gotten ahead of themselves, which creates the setup for a bona fide 10% correction in the S&P 500 if it comes to roost. So let's bring it full circle. While I expect the government reopening to be a meaningful tailwind and take the boil off of the valuation concerns, it won't address this particular pain point surrounding some of the dynamics that are taking place in the AI ecosystem. I'm not sure if anything but time and continued execution can, but personally, I do subscribe to the belief that nothing is really wrong, and that if they're getting a little more erratic and eccentric, it's just because of the stress of running arguably the most important company on the planet. If you take another step back, you can make the argument that Sam Altman is becoming a sort of cult-like figure the same way that Elon Musk and Alex Karp have, and those have been phenomenal people to put your money behind. But at the same time, it also echoes, to like Sam Bankman-Fried and some others who were actually running a scheme that was illegitimate and resulted in the loss of capital. Personally, I think it's going to go more the way of Alex Karp and Elon Musk than Sam Bankman-Fried, but I'm only bringing this up to illustrate that these concerns are legitimate and should be taken with some degree of seriousness. But speaking of corporate execution healing all wounds, there are a number of names integral and adjacent to the AI story delivering their report card on corporate execution this week. I'm going to run through the names of them real quick. Monday, Quantum Champion, Rigetti, RGTI, data center kingpins, CoreWeave, and Nebuous. Both of those data center plays have deals with Microsoft. Tuesday, we got OKLO, a pre-revenue nuclear power play. They sound off. The creator of stablecoin USD Circle will print on Wednesday. I'll probably have a list of that laid out. I'll definitely have a list of it laid out in my blog. Now, all of these names are similar, and I've lumped them together because they're part of the leadership theme, they trade at high multiples, and therefore are speculative in nature. While the content of their report matters, I'm more interested in how the market is going to trade them. We left Friday, I think, feeling as though a solution to the government shutdown was somewhat imminent, so I'll be curious to see how the market trades them to get an update on investor appetite for risk and how strong the valuation ceiling remains. Again, assuming we wake up on Monday with the impression that Democrats and Republicans are talking about ending this thing. Before I move on to the next stock reporting, I think it's worth pointing out that OKLO uh, is undergoing a head and shoulders pattern. If this doesn't hold $100, the next level of support is the 100-day SMA somewhere in the low 90s. It's written there on the slide. Honestly, I think this creates a nice opportunity to do a bearish put spread between the current market price and that ascending 100-day simple moving average. If I end up doing it, I'll write a small piece for those unfamiliar with the option strategy so they can see it in real time and get a better idea of how I evaluate the return on those opportunities. With that, we're going to move to Applied Materials. They are a semiconductor manufacturing equipment company. In the past, their business with Intel has been a headwind, but now that Intel appears to be part of a legitimate turnaround, maybe this headwind subsides or, dare I say, becomes a tailwind. That'd be a crazy turn of events. I'm not long AMAT, but the levels to watch are resistance at the all-time high, somewhere like 245. It's about 13, 15 bucks above where the stock closed on Friday. To the upside and to the downside, I would expect support to come in at the $200 level where it had been resistance in July and then in the early part of the year where it just couldn't get past that level. Finally, we're going to talk a little bit about Cisco. They actually minted a new 52-week high last week. Can't say all-time high. The all-time high is back in the dot-com bubble. However, it couldn't hold above 72.5 into the weekend. I'm long this name. It's part of the two companies, the other one being IBM, these legacy tech companies that have properly reinvented and repositioned themselves to take advantage of AI opportunities. IBM's angle is software as consulting. Cisco's angle is networking infrastructure, scaling, and security. Listen, I'm obviously not super happy about the fact that it couldn't hold the new all-time high. And there are some bearish short-term signals emerging here, but earnings has the potential to change all of that. Still above all the moving averages. These major moving averages, the 50, 100, and 200-day, have positive slopes. That says they need to show up in the quarter. It's trading at 27.9 times trailing earnings with a forward earnings, a forward price to earnings ratio of 17.4. That big compression from 27.9 to 17.4 implies there is a lot of EPS growth expected over the next 12 months. So they need to show progress there this quarter. And speaking of progress, in the latter half of last week, election victories for the Democrats created a notion that a resolution was more likely now that there was a clear negative electoral consequence for the standoff. It is worth noting that the market didn't give up Friday's pop. There was a headline that Democrats were proposing a CR with the understanding that the Affordable Care Act health credits would be expanded only 1 year, and then there'd be further negotiation about what to do with them from there. Republicans quickly rejected this proposal, but because the market didn't give up that pop, I view it as an implicit endorsement of the idea that Friday's offer from the Democrats is going to be the start of a successful negotiation process as opposed to an open and closed offer rejection. I mean, of course, Monday morning, who knows, maybe we're falling out of bed because the market's changed its mind. But between these two new developments, I feel it is a good time to start looking for a way to play the reopening if this prospects interest you. Now, I'm going to be honest here. I think the entire market gets a little relief rally on the backs of this catalyst. Therefore, you don't really need to put on new positions to benefit from this. But I find this stuff interesting and I see some opportunities. So here we are. First, let's talk about consumer names. As I alluded to in the beginning of the brief, 1.4 million government workers have gone without a paycheck for well over a month now. That isn't good for local companies that serve those employees. It also means there's less leisure spending, more conscientious shopping and grocery trips. Furthermore, you have air traffic control staffing shortages leading to less flights. That means less tourism, less business travel. That means less business for the companies that ordinarily serve those travelers. So when it comes to this cohort of those names, I really like Shake Shack, which ticker symbol Shack, and Toast, ticker symbol TOST. So Toast without an A. Don't get me wrong, both charts do not look great right now. There's a lot to be desired, so be very careful here. I'm long both of these names. Toast, I got into last week. Shack, I've been into for about 3 or 4 months. I'm sitting on losses in Shack, and Toast is about even. As for buying signals, like this is what it would take for me to put more money to work, or if I didn't have a position to start a position. I need to see Shack above that 50-day. It would give me comfort that a durable base is forming. Some of the other similar companies like Chipotle, Akava, all of them look bad. This shockingly doesn't look like the worst of them. I think that is an implicit endorsement that this name could really be getting it right. It has been getting it right. It's just best house in a bad neighborhood kind of situation. Caveat being, this is not even I thought it was a $10 billion company. It's a $4 billion company, so our market cap company. So very small volatility, feature, not a bug. Next, Toast. Above $40. That I want to see this company regain the elevated trading range it was in before it lost it. This name got caught up in a pretty big sell-off associated with some poor reports from, I think, Fiserv and Chime. Toast just reported last week, showed the market that it is not affecting them. In fact, they might be the reason that a company like Chime isn't doing as well. In other words, they're becoming the market share leader. They're becoming the Uber of the space. So, if you're interested in either, do your homework, size them appropriately. Again, both small emerging growth companies. Volatility is a feature, not a bug. But just a quick recap on Shack and Toast. Shack above the 50-day, Toast above 40. Get some consecutive closes above those levels. That would get me comfortable to start a new position or to add to my current position. So the second opportunity I want to go over, to me, this is the most obvious. It is the airlines. Air traffic control shortage limits the number of potential flights. We just saw last week they're thinking about cutting 10%, and they came out again and said, we will continue to cut flights as needed to make sure that the air traffic controllers that we do have are not overworked or that we don't overwhelm them. So less flights translates to less revenue for these airlines. So after a little bit of thought and a little bit of browsing, I ended up buying American Airlines, ticker symbol AAL, last week. I just like the chart the most. The thesis here is that once the government reopens, the stock gets above $14. That has been resistance for the past, 6-9 months, permitting a revisit at resistance at 15 and then 16. Now, between this range is where I would look to take profits. Like if it gets clearly rejected at 15, then I got in last week, so I'm in it, like, let's call it 13 and a half. Great profit at 15. I would just take it. The airlines, in my opinion, is not an investable space. Look up any long-term chart. It's just it's working against you. But that doesn't mean you can't make a lot of money trading these, especially when you can see a clear catalyst. Now, if you don't like American Airlines in particular, but you like the idea, I'll let you know that I think Delta, DAL, is the bib or best in breed. Southwest, ticker symbol LOVE, LUV. This should be the biggest mover because they have the most exposure to domestic routes. And if you don't want to get in on either, you just kind of want to play the theme, there's nothing wrong with simply doing this in the JETS ETF. It has a 40% exposure that's spread pretty much equally between American, Southwest, Delta, and United. Last word on this again, it's a trade. I'm not going to get married to any of this. We're going on a date. Hope it's a good one, but either way it will end and we will part ways. So thank you so much for stopping by. I appreciate you giving me a little extra time. I know I went way over the normal allotment. I hope you learned something and left with a new name or two for your watch list. None of this is financial advice. I'm just showing you how I would run the money. Good luck on the markets out there. I'll be here next week. I hope to see you again too. Bye.